Warren Buffett just sold over $100 billion in stocks. Not 10 billion, not 50 billion, over 100 billion. Buffett does not panic. Buffett does not sell on fear. When Buffett sells this much stock this quickly, he is seeing something in the data that most people are missing. In this video, I'm going to show you exactly what he sold, when he sold it, and what chart he is watching that caused him to exit the largest position in market history. Value proposition. By the end of this video, you will understand what Buffett sold, why the timing matters, and what specific market indicator he watches that is flashing red right now. What Buffett sold. Let me give you the numbers first. Between mid-2024 and early 2026, Berkshire Hathaway reduced its stock holdings by over $100 billion. Most of that came from selling Apple stock, Berkshire's largest position. Buffett did not sell all of it, but he cut the position by more than half. That is billions of dollars of Apple stock liquidated over 18 months. At the same time, Berkshire's cash position climbed to an all-time record high, over $300 billion sitting in cash and treasury bills. That is more cash than Berkshire has ever held in its history. Now, here's what matters about that timing. Buffett started selling in mid-2024 when the market was near all-time highs. Apple was trading at peak valuations. He was selling into strength, the exact opposite of what retail investors do. And he kept selling through 2025, even as the market continued climbing. By early 2026, Berkshire had liquidated over $100 billion in equities and was sitting on the largest cash pile in company history. That is not market timing. That is risk reduction. The chart Buffett watches. So what chart is Buffett watching that caused him to do this? Buffett has said publicly for decades that he watches one metric more than any other when deciding whether stocks are overvalued, the market cap to GDP ratio. It is simple. You take the total value of the US stock market and divide it by US GDP. If stocks are worth more than the economy produces, that ratio goes above 100%. Historically, when that ratio goes above 140%, the market is in bubble territory. And when it goes above 180%, crashes follow. Right now, in early 2026, that ratio is sitting at approximately 195%. That is higher than it was before the 2000 dot-com crash, higher than before 2008. The only other time it was this high was right before the dot-com bubble burst. Buffett is watching that chart, and that chart is telling him stocks are severely overvalued relative to what the economy actually produces. So he sold $100 billion and moved to cash. Why this matters now, you need to understand what Buffett selling means in the context of 2026. Buffett does not sell because he thinks the market will drop 10%. He sells when he thinks the risk reward is broken, when downside risk is significantly larger than upside potential. A market cap to GDP ratio of 195% means stocks would have to fall approximately 50% just to get back to historical averages. Not to get cheap, just to get back to normal. That is the math Buffett is seeing, and that is why he is holding $300 billion in cash instead of stocks. Now combine that with everything else happening in early 2026. The inverted yield curve, widening credit spreads, deteriorating market breadth, 4 out of 5 crash indicators flashing red. Buffett is not reacting to those indicators. He's ahead of them. He started selling 18 months ago when most people thought the market would keep going up forever. And now those indicators are catching up to what he already saw in the valuation data. What Buffett is waiting for. Here is the part most people miss. Buffett is not selling to get out of the market forever. He is selling to wait for better prices. When the market cap to GDP ratio falls back toward 100%, which would require a 50% market decline from current levels, Buffett will have $300 billion in cash ready to deploy at much better valuations. That is how he has always operated. Sell high, hold cash, wait for the crash, buy low. The 2008 financial crisis was one of the most profitable periods in Berkshire's history because Buffett had cash when everyone else was forced to sell. He bought Goldman Sachs and Bank of America at distressed prices and made tens of billions. Right now, he is setting up for the same playbook. Sell at 195% market cap to GDP. Hold cash. Wait for the ratio to fall back toward 100%. Then deploy $300 billion at much better prices. The question is not whether Buffett thinks a crash is coming. The question is whether you are positioned the same way he is. Disclaimer. This is educational analysis of Buffett's investment moves and market valuation metrics, not financial advice. Call to action. Warren Buffett sold over $100 billion in stocks and is holding the largest cash position in Berkshire's history. The market cap to GDP ratio is at 195%, higher than before the 2000 and 2008 crashes. If you want updates on market valuation and crash indicators, subscribe. Is Buffett right, or is this time different? Check the video on screen about the inverted yield curve, another indicator Buffett watches closely. See you in the next one.